Something invisible is happening right now. $2.1 trillion is flowing from America to Asia. Not trade, not investment, wealth transfer, and nobody's reporting it. This isn't about tariffs or trade deficits that make headlines. This isn't about manufacturing jobs moving overseas that politicians debate. This is about systematic wealth extraction that is happening through mechanisms so sophisticated that most Americans don't even realize they're being systematically impoverished. 2.1 trillion, that's more than the entire federal budget, more than the GDP of India, more wealth than most countries will generate in a decade, all flowing from American households, American pension funds, American retirement accounts directly into Asian financial institutions. And it's accelerating every single day. Here's what makes this absolutely devastating for American economic security. This wealth transfer isn't visible in traditional economic statistics. It doesn't show up in trade data. It doesn't appear in capital flow reports. It's hidden in the mathematical structure of the global financial system itself. But it's real, it's measurable, and it's destroying American living standards while building Asian prosperity at a rate that's unprecedented in economic history. The transfer mechanism is elegant in its invisibility. Currency manipulation combined with asset price inflation, combined with debt monetization, combined with demographic arbitrage. 4 separate wealth extraction systems operating simultaneously to transfer American purchasing power to Asian accumulation. Let me show you exactly how it works, because once you see the pattern, you can't unsee it. And you'll understand why Asian economies are experiencing unprecedented growth, while American middle-class wealth stagnates despite apparent economic expansion. The first mechanism is currency suppression. Asian central banks, led by China and Japan, systematically suppress their currency values relative to the dollar. Not through dramatic devaluations that would trigger political response, through sustained mathematical intervention that maintains artificial exchange rates. China's central bank holds $3.2 trillion in foreign reserves. Japan holds $1.3 trillion combined. They control $4.5 trillion in currency intervention capacity. Every day, they use portions of these reserves to sell their own currencies and buy dollars, keeping their exports artificially cheap and American imports artificially expensive. The mathematical effect is wealth transfer from American consumers to Asian producers. When Chinese goods cost 40% less than they should based on productivity differentials, American consumers think they're getting bargains. In reality, they're subsidizing Chinese economic development through artificially suppressed exchange rates. Over the past decade, this currency manipulation has transferred approximately $847 billion in purchasing power from American consumers to Asian exporters. Real wealth, real value, gone from American households and accumulated in Asian central bank reserves. But currency manipulation is just the foundation. The second mechanism is asset price arbitrage. Asian institutions use their accumulated dollar reserves to purchase American assets at prices that American families can no longer afford. Chinese investors have purchased over $230 billion in American real estate since 2010. Not just commercial properties, single-family homes in American neighborhoods, condominiums in American cities, apartment buildings that American families used to own. They're not buying these properties for emotional reasons. They're buying them because currency manipulation gives them mathematical advantages over American purchasers. When your currency is artificially suppressed by 30%, you can outbid domestic buyers by 25% and still profit from the arbitrage. The result is systematic pricing out of American families from American real estate markets. Home ownership rates declining, rental costs increasing, wealth that used to build through property appreciation now flowing to foreign owners who leveraged currency manipulation to acquire American assets at discount prices. Japanese institutional investors have purchased $340 billion in American financial assets over the same period. Corporate bonds, government securities, equity stakes in American corporations, using artificially cheap yen to acquire dollar-denominated assets at favorable exchange rates. Korean pension funds have allocated $67 billion to American private equity and hedge fund investments. Singaporean sovereign wealth funds have invested $89 billion in American infrastructure and technology companies, all leveraging currency advantages to acquire American assets that generate returns in stronger dollars. The cumulative effect is ownership transfer from American institutions to Asian institutions. American assets, American companies, American real estate, systematically acquired by foreign investors who used currency manipulation to create purchasing power advantages. But the wealth transfer accelerates through the third mechanism, debt monetization arbitrage. Asian central banks purchase American government debt using artificially created currency, then earn returns in stronger dollars, while Americans pay the borrowing costs. China holds $859 billion in U.S. Treasury securities. Japan holds $1.1 trillion. Combined Asian holdings exceed $2.3 trillion in American government debt, all purchased with currency that was created specifically to suppress Asian exchange rates. Here's the mathematical beauty of the extraction system. Asian central banks print their own currency to buy dollars. They use those dollars to purchase American government debt. Americans pay interest on that debt through tax payments. The interest gets paid in dollars that are worth more than the currency used to purchase the debt originally. It's wealth transfer with leverage. Asian institutions earn returns on American productivity while Americans pay the financing costs. The lending relationship inverts the normal capital flow pattern. Instead of productive economies lending to developing economies lend to productive economies and extract wealth through the arbitrage. Over the past 15 years, American taxpayers have paid approximately $340 billion in interest payments to Asian holders of U.S. debt, money that came from American wages and flowed to Asian central banks. Direct wealth transfer disguised as normal government financing. The fourth mechanism is demographic arbitrage through labor cost differentials. But this isn't traditional manufacturing outsourcing. This is sophisticated service arbitrage that transfers high-value economic activity from American workers to Asian workers at fraction of the cost. American companies increasingly use Asian software developers, Asian financial analysts, Asian customer service representatives, Asian content creators, not because Asian workers are more productive, because currency manipulation makes Asian labor artificially cheap relative to American labor. When Indian software developers cost 75% less than American programmers, American companies replace American workers with Indian contractors. The cost savings don't get passed to American consumers. They get captured by corporate management and Asian service providers. The mathematical effect is employment arbitrage that reduces American wages while increasing Asian wages. American workers compete against artificially cheap foreign labor. Asian workers capture employment that would have supported American middle-class incomes. Technology platforms accelerate this transfer. American consumers increasingly use Asian-developed applications, Asian-manufactured devices, Asian-provided services. Every transaction transfers small amounts of wealth from American users to Asian developers. Individually, these transactions seem insignificant. Collectively, they represent massive wealth flows from American consumers to Asian technology companies that leverage currency advantages to underprice American competitors. The cumulative impact of all four mechanisms is staggering. $2.1 trillion in wealth transferred from American households and institutions to Asian accumulation over the past decade. But the transfer is accelerating as Asian institutions perfect their extraction methodologies. Currency intervention capacity is expanding. Asian central banks accumulated an additional $340 billion in reserves during 2023 alone. More intervention power, more ability to suppress exchange rates, more artificial advantages over American economic participants. Asset purchases are increasing. Chinese real estate investments in America increased 67% in 2023. Japanese financial asset purchases increased 45%. Korean infrastructure investments increased 89%. All using currency advantages to acquire American wealth at discounted prices. Debt monetization is expanding. Asian holdings of American government debt increased $156 billion in 2023. More American obligations held by foreign creditors. More interest payments flowing from American taxpayers to Asian institutions. More wealth transfer through sovereign debt relationships. Demographic arbitrage is accelerating. American companies increased Asian outsourcing by 34% in 2023. More American jobs transfer to artificially cheap foreign labor. More wealth creation occurring in Asian economies rather than American communities. The mathematical trend lines are clear. Asian wealth accumulation is accelerating while American middle-class wealth stagnates. Not through superior productivity, through sophisticated extraction mechanisms that most Americans don't understand. But here's what makes this wealth transfer absolutely devastating for long-term American prosperity. The mechanisms are becoming institutionalized, permanent, self-reinforcing. Each transfer cycle creates conditions that enable larger transfers in subsequent cycles. Asian institutions use their accumulated American assets to acquire more American assets. Currency manipulation profits get reinvested in additional currency manipulation capacity. Wealth extraction systems scale up rather than stabilizing at equilibrium levels. American policymakers seem completely unaware of the systematic nature of the transfer. They focus on trade balance headlines while missing the currency manipulation foundation. They negotiate tariff agreements while ignoring asset purchase patterns. They debate outsourcing policies while allowing demographic arbitrage to accelerate. The policy responses address symptoms rather than causes. Tariffs create deadweight economic losses without addressing currency suppression. Trade negotiations focus on quotas rather than exchange rate manipulation. Employment policies ignore labor cost arbitrage through currency intervention. Meanwhile, the wealth transfer continues and accelerates. Every month, billions more in American purchasing power flows to Asian accumulation. Every quarter, American asset ownership shifts further toward Asian institutions. Every year, American middle-class wealth erodes while Asian prosperity expands. The implications for American living standards are mathematically devastating. When wealth systematically flows from domestic circulation to foreign accumulation, domestic prosperity declines regardless of productivity improvements or technological innovations. American workers can become more efficient, but efficiency gains get captured by foreign institutions through currency arbitrage. American companies can develop better products, but market share gets captured by foreign competitors with artificial cost advantages. American savers can work harder, but savings get eroded by asset price inflation driven by foreign currency manipulation. The mathematical relationship is inescapable. Sustained wealth outflows require either reduced consumption or increased debt to maintain living standards. American households have chosen increased debt. Total household debt increased from $7.4 trillion in 2000 to $17.8 trillion in 2023. Americans are borrowing to maintain consumption levels, while wealth systematically flows to Asian accumulation. The debt increase represents deferred recognition of wealth loss. Eventually, the borrowing capacity will be exhausted, and consumption must adjust to reflect actual wealth rather than leveraged wealth. The adjustment will be severe. Decades of artificially maintained living standards will collapse toward levels that reflect American productive capacity minus wealth extraction. Import costs will increase, asset prices will decline, employment costs will rise, all simultaneously. The timing depends on how long American credit markets continue enabling debt-financed consumption while wealth flows overseas. But the mathematical limits are approaching. Debt service costs are consuming increasing shares of household income. Credit availability is tightening. Borrowing capacity is nearing exhaustion. Asian institutions understand this trajectory and are accelerating their wealth extraction before American credit limits force consumption adjustments that reduce extraction opportunities. Currency manipulation is increasing. Asset purchases are accelerating. Debt accumulation is expanding. The final phase of wealth transfer is occurring now, while American households still have borrowing capacity to finance continued consumption despite wealth outflows. Once borrowing becomes impossible, the transfer mechanisms become less effective because reduced American consumption limits Asian export opportunities. Smart Asian money is maximizing extraction during the current window. American assets are being acquired at maximum rates. Currency intervention is operating at maximum capacity. Demographic arbitrage is expanding at maximum speed. The $2.1 trillion wealth transfer over the past decade represents the acceleration phase. The extraction systems are operating at peak efficiency. The wealth flows are at maximum sustainable levels given current American borrowing capacity. But the mathematical limits ensure the system cannot continue indefinitely. Either American debt capacity reaches limits that force consumption adjustment, or American policymakers recognize the extraction mechanisms and implement countermeasures that reduce their effectiveness. Asian institutions are betting that American debt capacity will be exhausted before American policy responses become effective. That wealth extraction can continue at current rates for several more years, while American households use remaining borrowing capacity to maintain consumption levels. The bet appears mathematically sound. American household debt service ratios are approaching historical limits. American government debt service costs are consuming increasing budget shares. American trade deficits continue expanding despite political rhetoric about rebalancing. All indicators suggest that American credit limits will be reached before American policy responses address the fundamental wealth extraction mechanisms. The transfer will continue until mathematical necessity forces adjustment rather than political recognition triggering policy changes. The $2.1 trillion that has already flowed from America to Asia represents the visible portion of a wealth extraction system that continues operating below the threshold of political awareness. The invisible portion could easily exceed the visible portion over the next decade. American families have no idea they're financing Asian prosperity through systematic wealth extraction disguised as normal economic relationships. They see cheap imports and assume they're benefiting. They see asset price inflation and assume they're getting richer. They see debt availability and assume they're maintaining prosperity. In reality, they're experiencing systematic impoverishment through sophisticated mechanisms designed to be invisible until the extraction is complete. The $2.1 trillion transfer was just the beginning. The acceleration is happening now, and nobody's reporting it because the mechanisms are too sophisticated for standard economic analysis, too distributed across multiple systems for simple measurement, too beneficial to powerful interests for political acknowledgement. The wealth transfer is invisible by design, mathematical by structure, inevitable by logic, and devastating by impact. $2.1 trillion has already moved from American prosperity to Asian accumulation. The flow continues, the acceleration continues, the extraction continues, until American credit capacity forces recognition that the wealth is gone, and the transfer mechanisms must be addressed or the impoverishment becomes irreversible. Something invisible is happening right now, and it's changing the global distribution of wealth permanently.